Now, let's just remind you where oil is currently trading at the moment. $100.56 on the Brent crude price at the moment. What about exposure to oil here?
Well,
whether via directly or via majors.
Yeah, we're not taking a particularly strong view on oil individually at the moment. As I mentioned, we're pretty neutral on the broad basket of commodities. I have to think that oil feels as if it's got a fair bit of momentum behind it at the moment, and it's interesting, Ross, you saying, gosh, it could get as high as 110. Well, we were at 140 back in the summer of 2008. It wasn't that long ago, was it? And so 110, 100 is clearly a psychological barrier which we seem to be breaking, and that could easily open the way to further rises, particularly given this quite good economic momentum which does seem to be building, and with the West beginning to join in. So it looks as if for the time being for oil, which what I'm saying really is compared to other commodities has not run very far at all, could be due a bit of catch-up.
All right, let's get the view of Neil Atkinson. He's Director for Energy and Research Analysis at Datamonitor. Do you agree with that, Neil?
Well, yes, oil may be due a bit of a catch-up, but I think we need to make a clear distinction between the situation at the beginning and the early months of 2011 and the 2008 period where you were talking about $140 a barrel. The big problem in 2008 is that there was very, very little spare capacity, certainly on the production side and pretty well everywhere else in the whole of the supply chain in the international oil industry. At the beginning of 2011, yes, demand is beginning to pick up again from the lows we saw in 2009, picked up again in 2010, more in 2011. There is still plenty of spare capacity out there, not just in production, but also in refining, in shipping, pipelines, any part of the infrastructure that you want to look at. There is spare capacity. That doesn't mean, of course, that prices won't go up. My belief is that prices will continue to rise gradually in line with demand. Now, what we've seen recently is a re-injection of our old friend, political uncertainty. Back in 2008, the political uncertainty was over Iranian nuclear intentions, disruptions to Nigerian operations, and various other things. In 2011, it's now apparently contagion in the Arab world, Tunisia, Egypt, what may be next. And there seems to be some momentum behind the prices based on fears, which I suspect are exaggerated, but we don't know, but based on fears that there could be supply disruptions affecting the Suez Canal or operations in Saudi Arabia or other key producers.
So this is the point I was referencing earlier. This is Kuwait's Supreme Petroleum Council. A member of that's predicted oil prices will reach $110 a barrel in the first half of the year and would go above it if the Egypt crisis continues. So he seems to be suggesting that actually, without the Egypt crisis getting any worse, we're going to hit 110 regardless.
Well, yeah, that's broadly in line with what I've been saying. I think prices will rise gradually. I don't think there is any question of that. The ability to...
In spite of excess supply?
Well, yes, because supply is managed.
Exactly, so it comes down to cartel discipline, really.
Well, the OPEC discipline is what matters. Now, OPEC is holding 2 or 3 million barrels a day, whatever it is, off the market. They have other spare production capacity. So the oil price is essentially still in the hands of OPEC. Now, their stated objective is a price range of $70 to $80 per barrel. Now, of course, that's clearly now under revision, but the price, although having gone through $100 a barrel, the Brent price in particular, we must make that distinction between the Brent price and the WTI price, it's not exactly gone surging through $100 a barrel. It did come down below 100 right at the very end of last week. So it's not as if there's a sort of surging momentum rising through $100 a barrel. We're still not that far away from a price which is regarded as acceptable to producers in terms of their income, but also its economic impact as far as consumers are concerned. It's still the Goldilocks price, not too hot, not too cold.
What price would there be when price starts to impact demand, do you think?
Well, I think there's still some mileage yet. I think once we start getting towards $120 a barrel, if we get to $120 a barrel quickly, then I think that you will suddenly start to talk in terms of shock, as opposed to a gradual increase.
Well, it's the boiling the frog metaphor, isn't it?
To some extent, yes, indeed. But cruelty to animals, obviously, is
I didn't mean it actually doing that, but that you know. the idea of you do it gently.
Yes, indeed.
Yeah.
Yeah.
Anyway, Neil, good to see you. I'm going to move on from that. Neil Atkinson, Director of Energy Research Analysis at Datamonitor.